We're very pleased with the performance of our core business. Profits before tax were up 4% year on year, and that was really driven by an increase in our top line, an increase in our income. Income was up 7%. Our cost performance was also good. Costs were up 6%, but with income up 7%, of course, we generated positive jaws in our core business. That increase in costs of 6% was including the increase in compensation charge of 400 million. So it's pleasing to see positive jaws. And actually, if you measure costs in underlying currency on a constant currency basis, costs were actually down year on year. So overall, that generated a return of 9.4% for our core business. And in fact, that's pretty close to the double digits that we've talked about. And one thing that's worth pointing out, we've had very stable returns in our core business. If you look back on a quarterly basis, in most quarters, our core returns have been in double digits. Barclays UK generated a return of 19.3% over the course of the year, and that's a very strong return. That was driven by stable income of about £7.3 billion. And that was a very good performance because, of course, base rates were cut over the course of the year. Our net interest margin in that business was 362 basis points, and that was slightly up year on year. Again, very pleasing performance, and it shows the pricing discipline that that business has. Cost control was also very good. Costs were down 1%, so again, the business had positive jaws, and a cost-income ratio of 53%, which is very close to our target of a sub 50% cost-income ratio for that business over time. Barclays International had a good performance. It generated a return of 8% over last year, and that was mostly driven by an increase in our top line. In consumer cards and payments, income increased by 21%, and that was somewhat driven by the currency mix of our income. We generate quite a bit of our income in US dollars, but also genuine underlying growth across all of those businesses, whether it be in payments, whether it be in international cards, or indeed international private banking. Within our corporate and investment bank, we also had income growth of about 6% over the year. We had income growth in our markets business. Income was up by 9% year on year there, with a particularly strong performance in our credit trading businesses, where income was up by 44%. Our banking income was also up by 3% year on year, and we're very pleased with our market share in that business. We increased our market share across our US and our UK home markets to a combined 5th place. That's very important for us because those top 5 places are usually dominated by our US banking peers, and we actually broke into that top 5 for the first time this year, so very pleased with that. Progress on non-core has been very good. We've reduced risk-weighted assets by a further £22 billion over the course of the year, closing the year at £32 billion. We've sold virtually all of the businesses in non-core, and we've also made good progress in running down our derivatives book and winding down our loans and securities positions. We expect now to be closing non-core at the end of the first half of the year. That's 6 months earlier than we expected, and risk-weighted assets at that point should be around £25 billion. We do expect losses for non-core for the full year to be about £1 billion on a pre-tax basis. That'll be skewed towards the first half of the year, and we also expect those losses to continue to reduce, as they will have done in 2017 versus 16, but continue to reduce as we go into 2018 as well. Our capital position is very strong. We closed the year at 12.4% CET1, and that's a 100 basis points increase over the course of 2016. In fact, it's a 330 basis point increase over the last 3 years. We do expect to divest of our African banking businesses, and that should generate at least 75 basis points of additional capital. Of course, that's dependent somewhat on the share price and the currency rates at the time at which those divestitures take place. We do have some headwinds that we will no doubt face between now and then. There are some accounting changes, for example, IFRS 9, legacy litigation and conduct items, and there may be some changes to the risk-weighted assets rule set. But we feel very confident with the organic capital generation of the company that we'll be able to absorb them and meet our end-state capital requirements. We expect to hold about 150 to 200 basis points of additional capital above any end-state minimum requirements. So that should give us an end-state capital requirement of somewhere close to 13%, and we expect to get to that level in good time. We're very pleased with the progress we've made over 2016. I think you're beginning to see the benefits of diversification with our core returns stable and already at attractive levels. We've made good progress in non-core and we expect to close our non-core unit early. We've shown good income growth. We've shown very good cost control. We're running a very conservative risk profile within the company, and that puts us in a good position to deal with any macro political uncertainties that we may face over time. And we're on target to reach our end state capital requirements. We're very focused now as we move into 2017 and beyond is to converge the group returns to where the core returns are today and feel very confident in our ability to do that.